So mortgage rates go up, everything associated with housing just goes down. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today is the 22nd of September. Randy Patrick here, putting the realism back in real estate. Hope you're doing well. So, of course, big news yesterday, the Fed did raise interest rates 75 basis points. So that was expected. People were calling for 100 basis point raise, but I guess they settled at 75. So will this affect mortgage rates? Most likely will. We'll get into that in a second. What I want to hit first is basically information that came out this week as well from NAR. So every month, and I haven't talked about NAR stuff, National Association of Realtors, for a bit, just because it's been boring, the same old, same old. Well, now we're starting to see some material changes, so it's important to go through it. So the most recent NAR statistics came out this week. It's for August 2022. Big news is that we're just seeing lack of sales activity. So you can see, back about a year ago, we were looking at significant pace of sales, 6.5 million units sold, seasonally adjusted rates per year. Well, based on the activity where we're at now, the SAR, the seasonally adjusted rate, is only 4.8 million. So you can see there's a pretty big, significant pullback in sales activity across the board. Interesting enough, though, we've seen a decline in the median house price point. So we've gone from a high a few months ago of 413 and change to 389,500. So what we're seeing now is the effects of maybe additional listings, maybe some price reductions, maybe interest rates, crushing affordability for many people. So we're starting to see the slide take place. Again, this is August data, so whatever happened, yesterday with raising interest rates and the recent increase in mortgage rates again is not here to show the effect. That should happen in the next couple of months. We'll see that in the future. But again, we're seeing the slide that's very evident that we're going through the correction component of the crash. Now, obviously, existing home sales median price, as I said, still year over year it's increasing, but the percentage is increasing, and the percentage has come down from the peak, or the values actually come down from the peak. Home sales, so we're down, compared to last year, this time last year, we're down almost 20%. You could see that this time in July, compared to last year, 20%. So we're pretty much, roughly 20% per month now, less home sales. So basically loss of sales activity. By the way, this video brought to you by our friends at Foreclosure.com. So if you want to check out the distressed properties in your backyard, your neighborhood, go to gethousingdata.com. That's gethousingdata.com. It's my affiliate link. You can see the foreclosures, the tax deeds, other things that are going on, as I said, in your zip code, in your neck of the woods, and verify what I'm telling you guys, that foreclosures and stuff are happening. All right. So this is the confidence index survey that's part of their little presentation here. Obviously, you can see first-time home buyers. The comparison really boils down to this time last year, August 21 versus August 22. Current year, August 22 is the darker shading here. First-time home buyers, about the same, 29%. Sales to investors, slightly up. Cash sales, up a little bit more. Distressed sales, which are made up of short sales and foreclosed on property, bank-owned, that are called REOs, the same 1%. I can actually tell you that the number is probably less than 1%, but they don't go below 1% for the bar graph here. So it's probably actually less, but again, it's about the same as the year before. Days on the market, 16 days on market. Now, remember, August to me is the end month of the summer selling season. Now, the summer selling season does flux a little bit between on your location across the U.S. In the South, the summer selling season ends, end really July, early August, because school starts second, third week. Obviously, other parts of the country, Northeast, Midwest, whatever, school starts day after Labor Day. So you're seeing, the last little bit of sales, people, close, move, get their kids registered for school. September becomes a normalized month. So that's why we're seeing probably a little bit of activity based on the summer selling season end. When September hits, I expect we'll see an even bigger drop-off in everything housing related to in the month of September. So please keep that in mind. So home sales by region, South typically has the most, Midwest second, Northeast is last, 13%, West 18%. That's the volume of how it plays out across the regions. When we take a look at the sales by price range, you can see that the lower end homes, 0 to 100K, there's virtually makes up 4% of the marketplace, virtually nothing. 100 to 250K range, 22%. The bulk of the deals are done in the 250 to 500K range, 43%. Starting to go more to luxury, higher end homes, 500 to 750K, we're at 18%. Obviously, 750 to million, 7%, and a million above, 6%. So we know where the bulk of the activity is. Interesting to note, though, that smaller end, cheaper properties, you're just not finding them anywhere. That's why only 4% of the overall sales are $100,000 or less as far as the sale price is concerned. Now, obviously, we do the percent change in sales from a year ago by price range. You can see that the 0 to 100K losing 22% of sales, 100 to 250K, 26%. So to me, those two segments would make up affordable housing across the board. Even the 250 to 500K, there's 14% less sales compared to last year. And obviously, you can see the activity slow down for the higher end homes as well too. What does this really mean? It's a pullback. It means it's, number one, tougher to find cheaper properties. We know that. Number two, with increases since March in mortgage rates, it's just way more expensive, and it's hurting people's affordability and their buying power. Thus, we're seeing big decreases in all sales categories and all levels of price points, which again goes back down to that overall first or second slide when it talked about 4.8 million units. Is the adjusted rate for 2022 as opposed to the previous year, when it was around 6 million and change. So big pullback in what's happening in the world of real estate. Just so we talk about supply here, the bottom is the supply. So supply for July and August has pretty much remained the same. We're at 3 months supply. Real estate pundits, gurus, and analysts, whatever, economists, sort of always state that 6 months is what we call a balanced network. There's enough sales, not enough buyers out there, enough sellers out there putting their home on the market. Why is the inventory categorized, or I guess you could say you calculate it in months? Well, what this basically means is if no new deals came on the marketplace, came in the MLS going forward today, it would take about 3 months at the current sales pace to clear out everything that's in the MLS. So that's what we're looking at. 6 months being adjusted to have a balanced month. Remember, this is the existing home sales. I've also reported earlier this month that new home sales, so new construction, their volume is at over 10. They're 10.9 months worth of inventory. So that's really actually a buyer's market for the new home stuff. Unfortunately, it doesn't really affect the existing home numbers. That still has to grow, and we'll see that every month. We'll probably see an increase as time goes on, especially now that the fall's hitting here. Now, interesting enough, Market Trends report showing that in August, the largest year-over-year median list price growth occurred in Miami, 33%, Memphis, almost 26%, and Milwaukee, 25%. Those are the biggest, we'll call it, growth of new listings coming in the market. Phoenix reported the highest increase in the share of homes that had their prices reduced compared to last year at almost 31%, followed by Austin at almost 25%, and Vegas at 24%. So you can see that some of these markets are high, we'll call it very high appreciating markets over the past couple of years. And a lot of them are going to see increase in marketplace, increase activity, increase in listing volume, and we'll call it increase in price decreases. So increase in price decrease is a little tough to say there, but obviously those markets, they've had such a huge rise in prices that people want to sell. We've got FOMO going on now, fear of missing out. That's the acronym, FOMO, fear of missing out. So people want to put their home in the marketplace and want to sell. And yeah, their real estate agent advises them where to price point. They do. No activity. We got to we tried our price, didn't get it. We got to drop price now, etc. So we're going to see this going on, more coming on as the fall hits, more price points. Just as activity slows, sellers, homeowners have to be more aggressive to see what's happening out there. So, and by the way, if you guys appreciate the information I provide and my take on the industry, if you could please help my channel grow and subscribe, that'd be great. Also, if you're already a subscriber, if you could please resubscribe, verify. I lose subscribers every day for some apparent reason. So anyway, thank you very much, guys. All right, move forward here. So that's NAR, basically talking about sales dropping and actually having the median sales price come down. So sales slowing, price point it's showing now, it's becoming material. Obviously, with respect to what I mentioned earlier, the Fed increasing their interest rates by 75 basis points. Well, what we're going to see now is mortgage rates. So mortgage rates surged 27 basis points this week to levels last seen in the fall of 2008. So Freddie Mac said at the same time the benchmark 10-year Treasury rose to its highest level since 2011 as investors are worried about inflation. So here we go. The average weekly mortgage rates for 30-year fix, 15-year fix, and the 5/1 ARM are increasing. So clearly the most popular loan term being 30-year fixed rate mortgage has broken the 6 barrier. And essentially that came in at 6.29 for the previous 7 days. Obviously that was going up because there was talk and leakage about what the Fed was going to do. So it was already anticipated we'd have a 75 basis point increase in rates. So that didn't disappoint clearly. It's the highest 30-year fixed rate mortgage since the week of October 30th, 2008, when it peaked at 6.46. So here we are. So if you think about it, we're kind of really in the same time as the last housing crisis and crash. All right. So interest rates are now the same. We're starting to see the slide in sales activity. We're starting to see median price point drop. We're starting to see sales drop across the board. We're starting to see other things in the industry that are showing we have distress coming. So it really is almost like a repetition of what happened. We're talking over a decade ago. And as I always say, well now median home prices as a percentage of income is up 46% since the start of the pandemic. So I don't think people have had an increase in wages and income at the same pace, if any pace, as the home prices have gone up in home values. So that's the difference. So the fun part I'd like to talk about is the narrative, as and what people say and do with respect to real estate. So if we take a look, like this is a great example. CNBC always most TV shows and most stuff out there, they're bullish on the housing market. They're pro housing narrative. Rah rah rah, everything's great. Let's price points the whole bit. Well, we've seen a complete 180-degree shift in house, sentiment. I guess you could say we know national home builder sentiment's at its lowest level in a decade plus. Home buyer sentiment's low. It's always been low. It seems to be hovering at a very low number because there's just no good news for home buyers the past few months, right? But now when you have major news networks openly talking about a correction and even a crash at some point in time, to me, that's a whole other world that we haven't seen for quite some time. So as I have this chart up here, this little guideline that I like to use just to show what's happened in such a short period of time. So, January early this year, 2022, double-digit home price appreciation. That's what we're all talking about. Well, guess what? Underwhelming selling season's upon us. Mortgage rates have gone up, which has given us more listings, more price reductions, fewer bidding wars. We've seen contract cancellations due to a number of issues, but people backing out. People are okay actually walking away from escrow or earnest money deposit because in the end, they know these higher interest rates are going to cost them way more than the few $1,000s they've put down to secure a deal in the contract. The Fed has come out and said we need to reset the housing market. In fact, we're going to reset the housing market. That's what they're doing with their monetary policies. Mortgage rates now as high as back in 2008. So it's like deja vu. We're at the cusp of the last housing crash. Price declines are happening. We're seeing that in real time. The groups like the real economic analyst companies, okay, Moody's, Fitch Ratings, Goldman Sachs, they're calling for reductions in home price appreciation and overall decline in value. Now, each three of them, they have different, we'll call it value decrease ranges they're talking about, but some of them are talking about 15 to 20%, could be even more in certain markets across the country. The markets that went up quickest and go up, go up fast and high, usually the ones that fall fast and hard as well too. So it's going to be greater in some markets, but it's interesting to see where we've come from. So we've essentially, we're almost done the 9 month of the year, and there's a complete 180 as to what's happening in the real estate market. Very interesting. So, but again, my point, because I always want to stress this. So if Fitch, Moody's, and CNBC and Goldman and all the people are talking about home price declines, value declines, depreciation, all this just based on, what's coming on the market, affordability issues, mortgage rates going up, all that's happening, and they're predicting these numbers and this drop in value, which is good. It's correcting. That's why I'm calling what's going on now a correction. The crash will happen when we hear about these things. Okay, there's still little to no talk about delinquencies, about forbearance, about foreclosures. Nobody even referenced this in any of the discussion points with respect to where the property values are going. So again, delinquencies, we have many. They're out there. People are still not paying their mortgage. It's growing. Forbearance programs are still going on. I just read something earlier that they're going to do another, make some other extension available for forbearance. So it's just, things are doing that are really pushing off the inevitable for the homeowner. Foreclosures are ramping up, right? People are coming out of forbearance, going into loan mods, loan mod production. And if that doesn't work, well, guess what? You've got nowhere else to go but the foreclosure marketplace, okay? Foreclosures are ramping up with foreclosure activity, foreclosure auctions, foreclosure filing. The lenders are going back. If you ever watch my videos about the 3 waves of foreclosures, they're working on the backlog, the pre-2019 right now. We're seeing a lot of those older stuff coming to fruition. So it is ramping up. So this is what's going on now. A lot of this stuff hasn't hit the marketplace or hasn't been able, because the volume is again small, and it's growing now that everything's being caught up over the past couple of years and longer. So this element hasn't really been able to contribute to any downward pressure on the housing market. It certainly will in the future. That's why I look at it going, call it what we have now as a correction. When you add this stuff in, we'll be in a full-blown crash. So that's the scoop. Again, how many potential foreclosures are there? Well, I like to show this slide because back, when we're talking about forbearance and foreclosure moratoriums and eviction moratoriums, the current administration came out and said, 1 in 5 renters behind in rent, and just over 10 million people, homeowners, are behind on mortgage payments. So that, my friends, gives you a potential as to where it can go. I always say we hear anywhere from 3 million to this 10 million. Some people even say even more. It's going to rival the last housing crisis with respect to what could happen in the future. So that's what's going on in the real estate world today. Just as to end off here, obviously I'm looking for agents in Florida, not to partner with, but honestly to join my firm. Why? Because you'll get a lot of benefit doing the things that I do and knowing what I know and working in this distressed property market where we have unlimited buyers and unlimited funding for all this. Okay, I'd like to open up other metros across the country that seems to make sense and want investor buyers, want private lenders, syndication equity fund partners. We're working on stuff like tokenization of real estate, doing real estate as NFTs, crypto, the whole bit. We got a lot of stuff we're going that I don't even talk about here. So if you don't think I'm progressive in what I'm doing, I really am, and I'm trying to be on the forefront of a lot of things that are going to happen with traditional real estate investing, and where things are heading for the future. So a lot of things going on behind the scenes that you guys don't even know about. Obviously, I've got my new program now. I'm pre-selling my foreclosure fortunes with some nice discounts on it. Okay, get in now before the masses. Been talking to a lot of people. I can tell you that the inquiries and the movement in this distressed property market, the pre-foreclosure, foreclosure market, is increasing at a breakneck speed. Get into it. Get involved now. You don't want to be in the sidelines looking in. All right? Simple as that. So, again, if you want to get a hold of me, please send me an email. Give me your phone number. Once again, thank you for the views, likes, and comments. Please share the video to your family and friends. If you're not a subscriber, please help my channel grow and subscribe. And I look forward to speaking with you sometime over the weekend or early next week. Take care.